Today we're going to look into historically what has been probably the best investment of all time. Berkshire Hathaway, run by the most successful investor of all time and the fourth richest person in the world, Warren Buffett. So you want to be a big time investor? Well, let's look at the best of the best. Hi, if this is the first time to my channel, welcome. My videos are all about lucrative investments that anyone in the world can make, not just the Americans. See, people invest in the stock market all the time, mostly because someone told them they should. So I'm trying to help you understand what it is you're actually buying. And by the way, it takes me a full day to put these together, so if you could hit the like button to help me grow and I can make more videos, that would be great. And today we're going to have a close look at Berkshire Hathaway, owned by Warren Buffett and Charlie Munger. Now, if you've never heard of Warren Buffett before, well, you must be very new to my videos, so welcome along. He is just the fourth richest person in the world and undoubtedly the greatest investor of our time. You might not have heard of Charlie Munger, but he is Warren Buffett's business partner, and Berkshire Hathaway, which they run since 1965, has returned 20.5% annual returns. Yes, that's 55 years now. So you like high returns and consistency? Well, it doesn't get much better than this. The cool thing is, as investors, we can just invest in Berkshire Hathaway and let the best investors of all time just do their thing. Now, they are definitely not gods, and they definitely don't get it right all of the time, but most of the time they do. See, recently Warren Buffett has actually been criticized really heavily by investors for making some bad decisions. Berkshire Hathaway was a big investor in the airlines, and as you know, they have been slaughtered recently. So much so that Warren Buffett had to break his own rule, which is never lose money. And he justified his reasoning to sell the airlines as he just wasn't sure what was going to happen to the industry over the next 10 to 20 years. For decades now, people have put Warren Buffett and Berkshire Hathaway on this pedestal as the best investor of all time. And just like anyone who is the best, people are very, very quick to criticize and talk about their downfall. And some large investors are actually really upset with Berkshire Hathaway's handling of the current crisis because they have $130 billion of cash, which is, by the way, the most cash that they've had on their books ever. And they didn't buy anything with the big price fall in late March 2020. In my opinion, I think these critics are just chasing a headline. Do you think it is a problem that someone has a mountain of cash? I think it's so obvious that they're just waiting for an amazing investment opportunity where they have all this cash ready to deploy and then they're just going to pounce, just like they have done for 55 years now. But the analysts and the investments, they call Warren Buffett boring and out of touch. This is very typical human behavior, but maybe this presents to us a really, really unique opportunity to buy into one of the best companies and the best investments of all time. So we will need to decide whether we think Berkshire Hathaway is going to be strong in 20 years time or is it going to fall away? So the first thing we need to address is that Warren and Charlie are 89 and 96 years old respectively. They are very old. So in the next 10 or 20 years, they're not going to be with us anymore, but the company will. So what will happen with the company? A lot of people think that Berkshire Hathaway is going to struggle once these two are gone, but I actually don't think so. Now, the next CEO hasn't been announced yet, but the two probable candidates are Ajit Jain and Greg Abel. And honestly, I don't think it matters which one takes over. The Berkshire Hathaway board and the new CEO have been with the company now for decades, and they know exactly how to invest. If you've worked with the greatest two investors for the last 30 years, well, I think you've probably learnt a few things. Oh, I haven't actually talked about exactly what Berkshire Hathaway even does. Sorry about that, let me quickly go over it now. Berkshire Hathaway is simply just this giant holding company for lots of different businesses. And Warren and Charlie, they're just simple guys who find the fair value of different businesses and invest in them for the long term. And now Berkshire Hathaway is the fifth largest company in the world. That's pretty amazing. They own a handful of companies outright. One that comes to mind is Geico, which is a big insurance company in America. And Berkshire Hathaway is a minority shareholder in companies like Apple, Bank of America, Coca-Cola, and many others. And these guys, they're old school. Warren actually pays himself $350,000 a year, which is one of the lowest paid CEOs in America. He lives in a simple average house in Omaha, Nebraska. There's no New York penthouses for these guys. There's no Silicon Valley either. And Charlie, he's only paid $100,000 because apparently that's all he wants. Of course, they have large amounts of shares in Berkshire Hathaway, the company. Warren Buffett actually has so many shares that it's worth $70 billion. And their philosophy is something that I try to incorporate into my own investments. That is to understand good business, value solid financials, and invest at prices with a good margin of safety. If you want any more proof that Warren and Charlie are the best, Berkshire Hathaway since 1965 to 2019 has returned 2,744,062%. That's right. And during the same time, The S&P 500 has returned a little under 20,000%. I don't think I have to say anymore. So if we were to just do the same thing as Warren and Charlie, even if we're not as good as them, we'll probably end up as billionaires one day. So it isn't even rocket science. The rules are quite clear. So why don't more investors just copy them? Well, there are actually many reasons, and most of it is psychology. And here are a few reasons. Most investors are just not patient. You need to wait until the price is good for you. Most investors have what's called FOMO, which is the fear of missing out. Most investors try to get rich quick. Instant gratification is a big driver of human emotion. We want to see our investment go up immediately. An amazing startup company that is going to change the world, people invest into the story a lot, but not Berkshire. Opportunities come in frequently, and you need to be ready. Most people don't know when the opportunity is staring at them because they haven't understood the investment or haven't got their own finances in order to take advantage. This is one of my favorite quotes. What we have learned from history is that people don't learn from history. So these are just some of the reasons why people just can't copy Buffett. And I don't think I'm good enough to copy him either, but I'm going to try to get as close as I can because I think it is smart to try to emulate and learn from the best. Now, before I just hand over all my money, I really want to go through their finances just to make sure that I'm comfortable with the investment and that I'm going to get a decent margin of safety. Now, I find this kind of funny because I've studied Warren and Charlie for many years now. I'm going to apply the principles that I've learned in investing from them to their own company. Imagine if their own business didn't pass any of my criteria. It's pretty much their own criteria, but we'll go and see. And these are the three key areas we're going to look at. Does the company have too much debt? Is it growing? And is it a well-managed company? If you're new to value investing and looking over financials of a company, well, watch more videos of mine and you'll start to get the hang of it. And if you think this is boring, then maybe this is just not the strategy for you. Berkshire Hathaway has two different classes of shares. They have A-class shares and B-class shares. Now, the A-class shares are worth about $250,000 a share, which I can't afford, but the B-class shares are a lot more in my price range, so we're going to be looking at the B-class shares today. Now, these guys hate debt, so I can't imagine them having much debt on their books, but we'll go and look at their debt to equity ratio and their current ratio. And as you can see, the debt to equity ratio is 0.24, and I want to normally see that under 0.7, so that's good. And their current ratio is 0, so they don't have any current debt at all, so this is totally fine. Let's just move on. Are they growing? Now, Berkshire Hathaway's most recent mistake of selling all the airlines for a loss isn't going to show in the finances yet because it's only just happened. So I do expect a drop-off of about 20% from the end of the 2019 numbers. And you can see both graphs trending upwards. All is good here. Is the company well managed? Now, this criteria is a little bit funny because are the two best investors of all time, can they actually manage their company well? So I check for cash deployed into investing activities for the business, return on equity, and free cash flow, and if they got a dividend. Now, if we look exclusively at the cash for investing activities, this is where the critics want to see more spending. Because Berkshire Hathaway have so much cash, investors want them to use it. They spent a good amount in 2016, but that was too long ago for the critics. There is no dividend for Berkshire Hathaway, and this is something that the critics are also not happy with. Give that big pile of cash back to the shareholders, they say. But if you understand the philosophy of Warren and Charlie, you'll know that they're waiting for a good opportunity to deploy that cash into a really good investment. And my opinion is I don't have a problem with this at all. Also, just a quick explanation to the very low return on equity in 2019. So reporting metrics actually have changed in the US and companies had to show earnings even if they hadn't sold their shares. Now, whatever the value was on December 31st was the earnings for that year. It really doesn't make a lot of sense. So for holding companies like Berkshire Hathaway, return on equity and earnings per share are not good measures anymore for this type of company. But we want to see the book value per share and we want to see this solid. And as you can see, this one looks very good. So we can give them a tick for management. So is Berkshire Hathaway a good company to invest in? I'm going to now determine what prices I want to pay and make sure I have a good margin of safety. And if you want to learn more about margin of safety, I made an entire video about this topic called How to Calculate the Intrinsic Value. So please go back and watch that, and I talk about margin of safety and how to calculate this. I'll also leave a link in the description below for the calculator that I use to find intrinsic value. So if you want your free copy of that, just use the link below. So this is how we're going to work out the fair value for Berkshire Hathaway. So the first thing we need to do is the growth rates. And I've put in 14% for years 1 to 5 and 13% for years 6 to 10. Now the analysts actually think it's going to be 23% from years 1 to 5. So this is very conservative, dropping it all the way down to 14. So then we'll move on to my ROI goal, which is 20%, including a margin of safety, because I want 15%, but this gives us a bit of a buffer. Multiple we could sell it for after 10 years. Now I've put in 12. Now Berkshire Hathaway historically sort of trades at around about 17, 18 times PE ratio, but 12 is, again, let's be conservative. The operating cash flow minus maintenance capex is 38,000 millions, so it's actually 38 billion, and the shares outstanding is 2.445 billion. And the price that I want to buy it at is 196.53, which is significantly, this price is actually higher than the current price it is right now. So this is great news. So let's move on to the second buy. And I've gone a little bit more conservative again, like I normally do. So 13, 11, a bigger margin of safety, same multiple, same operating cash flow, same shares outstanding. The second buy price now is $160. So that'd be a great price to be getting in at. And then I go down to the third very aggressive buy, which is very unlikely, but if it ever did get this low, this is just too good to be true, really. You just have to be buying. So we're 13, 11, 30%. So that's a huge margin of safety now. So same as 12. 12 is normal. 36,000 is actually a little less than the 38,000, just in case there's a bit of a fall in the operating cash flow. And shares outstanding stays the same. So the third price, if it ever got to this price, is about $100. Well, $99. It's currently late May 2020. And if you're from the future, well, I apologize, because this is such a good deal at $175 being the current price. Now, don't get this confused with me trying to time the market. See, I don't really know where it's going to go up or down in the short term. I have simply worked out the value of the company to get the return that I want with a good margin of safety, and because it's below this price, I should go shopping. Warren Buffett himself would say, be fearful when others are greedy and be greedy when others are fearful. And I think this applies to his own company, because right now, the company is valued, I think, below fair value. Therefore, it's a great buy. And the only reason I think the share price is where it is anyway is because I think the company has been criticized a lot, and there's a lot of bad sentiment towards Warren Buffett and the company. I have a big margin of safety. I was conservative with my growth numbers because analysts think that it's going to be about 23.5% over the next 5 years, and I used 14%. I can't believe I'm finally going to be a buyer of Berkshire Hathaway. I've actually admired this company from afar for such a long time, but it's never been at a price that I could get with a good margin of safety. But my time has come. I'm a big buyer at this price. And I plan to hold it forever, and I might even buy some more if the market keeps offering me these crazy low prices. It might actually become one of the biggest parts of my portfolio. Please subscribe to my channel to see more of my videos. And don't forget to get your free intrinsic value calculator in the description below, and I will see you in the next video.